So when I was watching this last election season, I saw a lot of talk about our foreign debt, especially with China. Now that's something you don't normally get in U.S. politics. So there was plenty of talk, but it wasn't exactly on target. Like most media, it was pretty oversimplified. I'll give you an example. Now all of this was coming through, and was it really educating the American people? Were they getting it right? So there were really two critiques of our relationship with China this past election season. Now, one of them was that we buy too much Chinese stuff, and the other was that we're really threatened by our debt with China. So let's look at the first. So essentially, there's a lot of concern about our trade deficit. And as you can see, it's a very large trade deficit. That pink line is China's exports to the U.S., and that blue line is the United States' exports to China. So there's a massive difference between them. And as you can see, even those growth rates are pretty large, that the Chinese exports to the U.S. are growing a lot faster, in most cases, than our exports to them. Of course, the financial crisis has somewhat narrowed the gap, but it's still pretty sizable. And Americans get really uncomfortable about this, especially when they see what the outcome has been. For the past 30 years, China's been beating us in terms of economic growth pretty much every year. Now, of course, they're a developing country and we're an advanced industrial democracy, but still, they see China starting to catch up with us. Here's a log scale of their GDP against ours. And as you can see, they're starting to get closer and closer. So Americans, when they see that, and combined with a low renminbi, and what they see as unfair Chinese practices with their currency, then yes, that would get to people feeling a little bit threatened by the Chinese economy. There's also the critique that we borrow too much from the Chinese, that because of our current account deficit, because of the difference between what we import and export, that we have to borrow money from them just to buy their stuff, just to import from them. As you can see in this graph, it's from the Brookings Institution, that the blue lines have been our current account balance. The sort of purplish lines is theirs. And we've been running a much larger deficit, and that they've been making it up with that surplus in a lot of cases. Let's look at what that looks like when the Chinese decide to invest. They put their money, the money that they make exporting to the United States, into U.S. Treasury bonds, into dollars. Now, that blue line is how much foreign assets they're owning. And look, in every year, the majority of it has been dollar denominated. 2009, it was 1.3 trillion. More recently, it's been nearer to 1.5 trillion. And of course, that's raised a lot of concerns about the U.S. bargaining position, U.S. leverage in China, that they might be able to release those reserves and really mess with the American economy. But what would that really entail? To know that, we have to see that the relationship between trade and borrowing, it's really two sides of the same coin, that one causes the other, and they're both mutually reinforcing. So let's follow the path of trade. First, the goods are produced in China, sold to Americans, and that's very easy to do because the yuan is cheap against the dollar. The yuan is a weak currency relative to ours. So that gives them an advantage when exporting. So Americans have a current account deficit because we're not selling as much back to the Chinese. We're not selling as much back to the world as we take in. So we have to finance our purchases with debt. That's how the balance of payments works. That when we have a current account deficit, then we have to make it up by borrowing money and having our trade partners finance that. Essentially, we're taking consumption today, the stuff we import, and trading it for consumption in the future, when we're going to have to pay them back with interest. So China now has these enormous dollar reserves just from exporting to the United States and being paid in dollars. So it has all this money that it's sitting on, plus enormous savings from its own population, with really not enough liquidity or mobility within the banking sector to take care of that. So instead of converting it into renminbi, it takes those savings and it reinvests in U.S. debt because Americans need someone to finance what they're doing, what they're buying. So if it hadn't done that, it would convert the dollars into renminbi, but that would raise the value of the renminbi as more money flowed in. And that would make Chinese exports much more expensive for Americans and drive down the competitiveness of their goods. So now it owns so much debt, what can it do with that debt? What kind of leverage does that give it? Some people say that that means they own us, that because we owe them, that they can essentially call the shots in our foreign policy. And I don't think that's completely true. If they were actually to sell their treasuries, if they were to change their policy, we could see a few things happening. So remember, when they hold treasuries, they're investing in US dollars. And there's two ways to profit from holding that kind of foreign currency. You can get interest rates, which are pretty low on US Treasury bonds, but they're very low risk as well. Or there's the capital gain and capital loss. That's the amount gained from shifts in the renminbi and the dollar. You can think of it sort of the same way we have buy low and sell high in the stock market, that they've essentially bought the US dollar when it was relatively strong. If the US dollar gets weaker against the renminbi, then converting it, then cashing out, would involve a loss to them. Whereas if they bought the US dollar and it rose in value, it appreciated against the renminbi, then they would be buying low and selling high and making a capital gain. So they have to worry about the US dollar's position and its implications for those $1.3 trillion that they've got in the market. And so they can make very large capital gains or very large capital losses based on what the dollar and the renminbi do relative to each other. So if it sells the treasuries, that means a massive exit from the dollar. And that would essentially cause the dollar's value to collapse as all this wealth came out of it and went into the renminbi. So the renminbi would appreciate against the US dollar. Basically, they've taken such a large position within our market that just by selling off, they would have to start taking a loss on what they've sold. So that would also cause China's exports to become more expensive in the U.S. And their export sector would really struggle. So there's two main losses to that they wouldn't have as competitive of an export sector, and they would take capital losses on their other dollar-denominated assets if they started to sell them off. So we have to realize that they have a really strong interest in weakening their own currency and strengthening ours. So you can see it like this, that when you owe the bank $1,000, you've got a problem. You owe the bank $1 million, the bank has a problem. You own them $1.3 trillion, and you own the mint, the bank has a big problem. But we should see, even if China faces costs in selling its treasury bonds, that there are ways in which they would have to meet those costs. There are ways that they would have to bear those. If there was a case of political or economic instability, when they really needed fast liquidity, when they really needed renminbi pushed into their system, when they really needed to do something with a lot of money, they might have to sell their treasuries. Or if they decided that the U.S. government is no longer a safe asset, no longer a safe debt to buy, then they might cease offering low rates on U.S. debt, and we would have to really reform our system and get ourselves off the large government deficits that we've been running for the past decade. So we should try to minimize the risk, even if the Chinese have an incentive to minimize it as well, and understand the incentives Beijing faces before we do something rash. So that gets us to a few lessons for American policy, a few simple suggestions. First, that it's not just about boosting exports. If they are manipulating or managing their currency, it's not just so that they can sell us more competitive goods. It's also because of the capital gains they can make on our treasuries. So if you deal with trade alone, that's not going to be as effective as addressing the root cause. And one of those root causes is our debt, is our low rate of national savings, and the fact that we run enormous government deficits. Now we're trying to confront that in the next Congress, but this just shows that it really is a high priority issue, that this is a root cause of many of our issues with the Chinese, and that because of the way the current account and the balance of payments works, we essentially have to keep borrowing to finance our consumption. And if we don't have, if we change our options, essentially, that can also change the relationship in a much more fundamental way. And the third is that even though weak dollar policies, even though expansionary monetary policy might be advantageous in many other ways, one thing it does run the risk of is driving China away from U.S. debt, or essentially making them not want to hold our currency as it depreciates, and making them angry that we've done so. So these are the main lessons to draw from the China-U.S. economic relationship. For a little bit of further education, I'll have to direct you to these guys.
That's right, with the world's reserve currency. In times of uncertainty, they all want USDs. So what if our fiscal picture is discombobulated? The world's resources are dollar denominated.